We are jumping straight into energy fuels today. If you've been watching the market, you already know the price action has been spectacular.
Absolutely.
The stock has been on, well, an absolute tear, rallied, 15% in some recent sessions, and the year-to-date returns for 2025 are just incredible.
They really are.
But here's the crucial point, and this is what we really need to unpack. The massive share gains aren't just about rising uranium prices, although that certainly helps.
Huh.
The real story here, the fundamental story, is the company's aggressive and strategic transition into what is basically the only vertically integrated critical minerals platform in the United States.
Exactly. That structural shift from being just a uranium miner to this strategic minerals processor, that's the core thesis the market is trying to price in right now.
And it's so complex.
It is. It's geopolitics. It's future project execution. It's the energy transition today. You're tuned into the Easy Money Show, where we focus on making sense of the market's biggest and, let's be honest, often most opaque moves. I'm glad you're with us as we try to unpack this story.
And if you're enjoying this breakdown, if you feel like we're cutting through the noise, make sure to subscribe and hit that like button. It really helps us out.
It does.
And definitely let us know in the comments which major market move you want us to simplify next.
All right, let's dig into the details. I mean, when you have a stock that's run this hard, you have to look at the foundations first. Let's dissect the bull case and the bear case for energy fuels right now.
Absolutely. And let's start with the foundation. The first thing that just jumps out in all the research is the sheer financial health of the company. It's the backbone for everything else.
That's the part that gets overlooked when people are just chasing the growth story. For a company in a cyclical, capital-intensive sector like mining, their balance sheet is almost unbelievably clean. They are effectively debt-free.
Yeah.
They wrapped up Q3 2025 with incredibly robust liquidity. We're talking nearly $300 million in working capital.
And that includes a big chunk of pure cash.
A very healthy chunk. $94 million in cash on hand.
That is massive for mitigating risk.
Yeah.
That financial stability lets them reinvest aggressively into those growth projects, the rare earth side, without having to dilute shareholders constantly. It's a cushion.
And they aren't just sitting on that cash, they are executing. On the traditional uranium side, they didn't just meet their 2025 guidance.
They over-delivered. And that's such a key indicator of strong management.
A huge indicator. They produced over 1 million pounds of finished uranium and mined over 1.6 million pounds of ore.
So that operational beat translates directly into sales visibility.
Precisely. You can see it in the projected Q4 2025 sales revenue, which should hit about $27 million. But that's just the short-term picture. The most important milestone, I think, was securing 2 new long-term contracts.
With major U.S. utilities.
Right. And these aren't short-term deals. These contracts stretch all the way out to 2032.
That visibility is so critical for the big institutional investors. They need that predictability. So looking out to next year, they already have a solid floor.
A very solid floor. They're projecting contracted deliveries of somewhere between 780,000 and 880,000 pounds, just under those deals. So whatever the spot price does, they have this predictable revenue stream.
And that's the anchor.
That's the anchor. It gives them the freedom to focus on the truly transformative part of the business, which is the rare earth processing.
Okay, here's where it gets really interesting. This is the competitive moat that I think justifies all the attention this stock is getting. We have to talk about the White Mesa Mill in Utah.
White Mesa it's more than just an asset. It is a piece of national strategic infrastructure.
It's the only conventional uranium mill operating in the U.S.
The only one. So it's the only place in the country where you can take uranium ore and mill it into yellowcake.
And what they've done over the past few years is, it's just pioneering. They engineered the ability to do rare earth separation at that same facility.
Which is a revolutionary concept. That dual capability uranium plus rare earths, it just doesn't exist anywhere else in the Western supply chain.
So let's elaborate on why that's such a game changer.
Well, most uranium is processed differently, but White Mesa is a conventional mill. So the technical team figured out how to adapt the circuits, the ones designed for uranium, to handle rare earth feedstock.
And they aren't just making a mixed concentrate, they are taking it all the way to high-purity, heavy rare earths. We're talking dysprosium oxide at, 99.9% purity?
That purity number, the 99.9%, that is the barrier to entry that China has dominated for decades.
Right. And dysprosium is essential for high-performance magnets.
For everything. Electric vehicle motors, wind turbines, defense applications. If that purity isn't near perfect, the magnets fail under heat or stress.
So this is not just an industrial story. It is a clear geopolitical story.
Absolutely. This capability directly supports the U.S. strategy to reduce reliance on Russia for nuclear fuel and, just as critically, on China for these essential rare earths. They are sitting at the physical intersection of two critical supply chains.
When you invest in this company, you're investing in a domestic answer to a global supply chain risk.
Exactly. And that leads us right to the future growth optionality, the Verramata projects in Madagascar and Brazil.
This is the moment where you realize the scale of their long-term vision. The feasibility study from Madagascar confirmed a massive resource base, but the number everyone is focused on
Is the NPV, the net present value.
a $1.8 billion NPV.
Let's break that down for a second. An NPV is what a future project is worth today after you factor in all the costs and risks. So a $1.8 billion NPV is enormous for a company this size. It confirms the economics are robust.
But the annual cash flow, that might be even more compelling. The project has the potential for over $500 million of annual EBITDA once it's up and running.
And that's where you go from being a small cap uranium play to a potential global powerhouse. $500 million in annual operating cash flow completely changes the company's profile.
And the calendar is already set for this. We're looking at Q1 2026 for pilot production of terbium oxide at White Mesa. Every one of these pilot phases de-risks the whole strategy.
So to sum up the bull case, you have superior execution in uranium, unique national infrastructure, and these massive de-risked global projects in the pipeline. It is a very compelling narrative.
But we have to transition to the risks. Because the market is a forward-looking machine, and this high valuation, well, it already reflects a lot of that future success.
Okay, let's unpack that valuation stretch, because this is where the volatility comes from. Despite all this potential, the $1.8 billion NTV, the company is still operating at a loss today.
And that's the core tension, isn't it?
It is. Consensus projected EPS is negative 33 cents in 2025, and it only improves to maybe negative 6 cents in 2026.
So the market isn't pricing current earnings. It is aggressively capitalizing on future optionality.
That's exactly right. And when you look at the price, the stock trades at a forward price-to-sales multiple of around 40.5 times.
40 times sales. That is a very, very steep premium.
It's extremely steep. To put that in perspective, the industry average is closer to 4 times sales. So Energy Fuel is trading at 10 times its peer group. The market is pricing in the full, flawless success of those rare earth projects right now.
And if the market is pricing in flawless execution, any setback, any delay at all, is going to be punished heavily.
It will. And we also noted the stock's beta is high, around 1.89, which means it's highly reactive. If the sector moves up 1%, the stock tends to move up almost 1.9%. But if the sector drops 1%, it drops by nearly the same amount. It just amplifies everything.
Which brings us back to Verramata. That $500 million EBITDA number is dazzling, but getting there requires flawless execution in difficult jurisdictions.
That's the biggest risk. You have to manage permitting, politics, large-scale construction in places like Madagascar and Brazil. These aren't just technical risks, they're geopolitical. Any project delays or cost overruns will directly challenge this high valuation.
And beyond operational risks, we have to look at the money flow, specifically insiders and institutions. When a stock is up over 180%, you usually see some profit-taking.
And we certainly did. We saw a recent insider selling from the CEO and the VP of sales, totaling nearly $7 million. Now, look, after a huge run, this can just be diversification.
Sure, taking some money off the table.
Exactly. But it is a data point. It shows that even the most informed people are being a little cautious at this valuation.
And we saw an institution mirror that caution. Stanley Lehman Group reduced its stake by almost 38%. That's a big move.
It is. So that profit-taking from both sides just confirms that volatility and execution timelines are serious considerations here. You are paying a steep premium for future cash flow.
So what does this all mean for you, the learner? I mean, you have a classic high-risk, high-reward proposition that's anchored by some truly unique, defensible assets.
Correct. The high valuation and short-term losses create unavoidable volatility. But the mitigating factor is that clean, debt-free balance sheet and those locked-in uranium contracts. That mitigates the immediate survival risk. This is a play on multi-year growth.
Absolutely. The core thesis is clear. Energy Fuels is a high-beta growth story anchored by unique U.S. assets and massive global projects. It's an American security asset that also happens to be a potential growth stock.
And that transition is a long-term, multi-year bet. You have to be willing to wait for it.
The market is betting heavily on that $1.8 billion NPV materializing on schedule. But here's the final provocative thought. Considering the U.S. government's push for nuclear security, like the $2.7 billion for uranium enrichment, what level of direct policy intervention could we see?
Like a subsidized offtake agreement or something like that.
Exactly. Could a policy like that effectively de-risk those projects even further and shorten that 5-year timeline? That's the multi-year question you should be mulling over.
Because that kind of policy decision could be what determines if they hit those aggressive targets and therefore if today's valuation is truly justified.
That's the lowdown on energy fuels for today. If you haven't already, subscribe so you don't miss our next breakdown. We'll catch you on the next one.